Cash back cards, the most common type of credit card. Every time you spend money, a percentage of that spending comes back to you as a cash reward. That percentage is called the cash back rate. Merchants pay a small fee to the card network every time a card is swiped. The bank keeps most of it and shares a portion with the cardholder as cash back. Cash back cards come in three varieties. Flat rate cards pay the same percentage on everything, usually around 2%. Category cards pay higher rates on specific spending types like 5% on gas or groceries and a lower base rate on everything else. Tiered cards blend both, offering multiple fixed rates across different categories at all times. One rule applies to every cash back card without exception. Carrying a balance destroys the math. These cards charge between 20 and 30% in annual interest. 1 month of unpaid balance can cost more than an entire year of accumulated cash back. Travel rewards cards. These cards pay in points or miles instead of cash. A point or a mile is a proprietary currency created by the card issuer. The issuer decides what it is worth and can change that value at any time. Different issuers create entirely separate point currencies that cannot be combined with each other. Travel cards typically charge annual fees ranging from about $95 to $550. The case for paying that fee is the card's built-in travel credits. A card charging $95 a year that includes $50 in hotel credits and a points bonus can earn its cost in the first year without a single trip. The limitation is the same as all rewards cards. Points accumulate in fractions of a cent. Interest charges arrive in full cents. 1 month of carrying a balance erases months of accumulated points. Travel rewards cards only make financial sense for people who pay their full balance every month. Balance transfer cards. A balance transfer card has one specific purpose: move existing high interest debt onto a new card, offering 0% interest for a limited time. Pay down the principal during that window and eliminate the debt before interest begins. The standard terms are a promotional window of 6 to 21 months and a transfer fee of 3 to 5% of the amount moved. Move $5,000 at a 3% fee and owe $150 up front. On a $5,000 balance, previously charging 23% annual interest, that fee pays for itself in less than 2 months. The danger is the deadline. When the promotional period ends, any remaining balance starts accruing interest at the card's standard rate, which typically runs between 22 and 29%. The card works exactly as promised for someone with a realistic monthly payment plan. Divide the balance by the number of promotional months. If that number is achievable, this card does its job. 0% introductory APR cards. These cards charge no interest on new purchases during an introductory period. That is the key distinction from a balance transfer card, which targets existing debt. A 0% APR card is designed for new spending you plan to pay off over time. The most common use is a large planned purchase. Someone buying $2,000 of furniture who needs 12 months to pay it off can use one of these cards, pay about $167 a month, and carry no interest at all. The same purchase on a card charging 22% would add roughly $240 in extra cost over that same period. Promotional windows typically run 12 to 15 months. The version of this product to avoid is deferred interest financing. A true 0% APR card eliminates interest entirely during the promotional period. A deferred interest card accumulates interest silently in the background and charges all of it at once if any balance remains when the promotion ends. Secured credit cards. A secured card requires a cash deposit up front. That deposit becomes the credit limit. Put down $200 and receive a $200 credit line. Use the card normally, pay each month, and after several months of on-time payments, The account typically graduates to a standard card, and the deposit is returned in full. The deposit is collateral, not a payment. If the cardholder stops paying, the bank keeps the deposit. This structure makes secured cards the easiest credit card to qualify for, regardless of credit history. Two groups rely on them: people rebuilding after a bankruptcy or a run of missed payments, and people with no credit history in this country at all. Both need to establish a payment record with the credit bureaus, and secured cards are the most direct path. One detail: most deposits earn no interest while sitting idle. The cardholder is building credit but getting no return on the cash deposited. Student credit cards, designed for college students with limited income and no established credit. These cards carry lower limits, typically $500 to $2,000, and slightly relaxed approval requirements compared to standard cards. The practical case for a student card is simple. 4 years of on-time payments builds a credit history that matters after graduation. When that same student applies for a car loan, signs a lease, or qualifies for a mortgage, lenders review a file that already shows years of responsible behavior. The risk most students miss is credit utilization. Utilization is the percentage of your available credit currently in use, and it accounts for 30% of a credit score. A $500 limit with $400 charged against it creates 80% utilization. That single number can drag a score down significantly, even if every payment arrives on time. Keep the balance well below the limit. Business credit cards, used to separate personal expenses from business expenses, track employee spending, and handle purchase volumes higher than most consumer cards allow. The account holder can issue cards to employees with individual spending limits and category controls. Two facts most small business owners miss. First, business credit cards are not covered by the same consumer protection laws that apply to personal cards. Issuers can raise rates with less notice and apply interest calculation methods prohibited on consumer accounts. Second, most small business cards require a personal guarantee. The owner signs for the debt personally. If the business stops paying, the obligation falls on the owner's personal credit. A business card is not a liability shield. It is a personal financial obligation with business expense tracking attached. Both facts are disclosed in the card agreement most applicants do not read before signing. Store credit cards, issued in partnership between a retailer and a bank. Store cards offer a same-day discount at the register and higher rewards when shopping at that specific retailer. The offer arrives at checkout when the customer is already committed to a purchase and a few minutes from leaving. The trade-off is the interest rate. Store cards carry among the highest rates of any card type, averaging 28 to 32% annually. A same-day discount disappears if the balance is not paid before the next statement. The offer is designed to be accepted quickly. The customer is already at the register. The discount feels real and immediate. The interest rate only becomes visible later, often after the card has been used again. For someone who shops regularly at one retailer and pays in full every month, the rewards are genuine. For anyone carrying a balance at 29%, the math runs entirely the other direction. Charge cards. A charge card has no preset spending limit and requires the full balance paid at the end of every billing cycle. There is no option to carry a balance. No preset spending limit does not mean unlimited. Each transaction is evaluated individually based on the account's payment history, income data, and established spending patterns rather than a fixed dollar ceiling. A cardholder with an established history can make large purchases well above their typical monthly spending. A new account with no history may be declined on the same transaction. The purpose is discipline by design. When the full balance must be paid each month, the cardholder cannot defer the question of whether they can actually afford something. Either the money will be there next month or it will not. More recently, some charge card issuers have introduced options to carry a portion of the balance at interest. That changes the core structure, blurring the line between a charge card and a standard revolving credit card. Credit Builder Cards, a variation on the secured card model that typically requires no cash deposit up front. Instead, monthly payments are held in a savings account and reported to credit bureaus as positive payment history at the end of a set period, usually 12 to 24 months. The cardholder receives the accumulated savings balance back. The business model is fees, monthly maintenance fees, annual fees, and sometimes an opening fee. Over 12 months, the total cost can reach $300 or more. Whether that cost makes sense depends on the alternative. A secured card from a no-fee issuer builds the same credit history without a monthly charge. Credit Builder Cards exist primarily for people who cannot qualify for a secured card at all, often due to a negative record in check systems, the banking industry's own screening database that tracks overdrafts and bounce checks. For that group, the fee is the price of entry to the credit system. Co-branded cards. A co-branded card carries two logos, the payment network and a partner brand, typically an airline, hotel chain, or large retailer. The cardholder earns the partner's reward currency and gains access to that brand's loyalty program. The value depends on how frequently the cardholder uses that specific partner. Someone who consistently flies one airline or stays in one hotel chain earns at maximum efficiency. Someone who books whoever is cheapest gets a restricted points currency with fewer options than a simple cash back card would provide. One risk worth knowing: the terms of a co-branded card are tied to the partnership agreement between the bank and the brand. When those partnerships change, the card's terms change. Cardholders have found themselves mid-relationship when a deal shifts, requiring them to navigate a new loyalty program or a new banking relationship. The card is only as stable as the partnership backing it. Premium cards. Premium credit cards compete on benefit quality rather than rewards rates. Annual fees typically range from $550 to several $1,000s. The case for the fee is offset math. The card's built-in travel credits and perks are worth more than the annual cost. A card charging $550 annually that includes airline fee credits, hotel status, lounge access, and global entry reimbursement can deliver over $1,000 of value to someone who uses all of it. For that cardholder, the fee pays for itself before the year ends. The system only works for people with travel volume and spending patterns that activate every credit. Someone who rarely travels is paying hundreds of dollars annually for a metal card and occasional airport lounge visits. The metal card itself became a status signal across the broader market. Many issuers now use heavy metal construction as a marketing cue, regardless of whether the underlying benefits justify the weight. Subprime cards issued to applicants with low credit scores, typically below 660. Subprime cards approve people that standard issuers decline. The higher risk of lending to borrowers with damaged credit histories is priced into the terms. Annual interest rates between 25 and 36% are standard. Annual fees of $75 to $99 are common. Initial credit limits of $200 to $500 are typical. High rates on subprime cards became possible after states began eliminating usury caps, the legal ceilings on interest rates that previously limited how much lenders could charge. Once those ceilings were removed, issuers could set rates wherever the market allowed. The structural problem is that subprime card fees can make credit improvement harder. A $99 annual fee on a $500 limit creates nearly 20% utilization before a single purchase is made. High utilization damages credit scores. The card sold as a credit building tool can slow the very process it promises to accelerate. Prepaid cards. A prepaid card is not a credit card. It runs on the same payment networks, looks identical in a wallet, but carries no credit line and builds no credit history. The cardholder loads money onto the card and spends it down. When the balance hits zero, the card declines. The primary market is households without a bank account. Approximately 6 million American households operate without one. Prepaid cards give those households access to electronic payments, direct deposit, and bill pay without requiring a banking relationship. Monthly fees, ATM fees, and reload fees are standard. A free checking account with a debit card does the same job at no monthly cost. The reason many people cannot access that free account is a negative record in checks systems, the banking industry's own screening database that tracks overdrafts and bounced checks. Prepaid cards exist partly because the banking system has its own exclusion mechanism, and this is one of its consequences. Deferred interest cards, one of the most dangerous financial products available to consumers and the most consistently misread. Offered at the point of sale for furniture, electronics, and medical procedures, it looks exactly like 0% financing. It is not. A true 0% APR card charges no interest during the promotional period. A deferred interest card accumulates interest at the full rate in the background throughout the promotion, but holds it. Pay the full balance before the end date, and the stored interest is forgiven. Leave any balance remaining on the final day, and every dollar of accumulated interest on the original full balance, and not just the remaining amount, charges all at once. A $2,000 purchase at 27% over 18 months. Payments of $105 for 17 months. A $60 balance remains at the end. The next statement includes over $700 in backdated interest. Two phrases that look similar but mean very different things. No interest if paid in full signals deferred interest. 0% APR signals genuine zero interest. That distinction is worth hundreds of dollars to anyone who knows it. You won. Creator cards, the newest category in consumer credit, designed for people whose income does not arrive as a salary or employer paycheck. These cards evaluate creditworthiness using social media metrics and platform revenue data instead of traditional credit scores. The problem they address is real. A full-time content creator earning consistent income through platform ad revenue and brand deals may be declined for a standard credit card because that income looks irregular to a model built around salary stubs. The income is real and verifiable. It simply does not arrive in the form the underwriting system was built to read. These cards treat a history of consistent platform earnings as equivalent to traditional employment income. Benefits typically include no preset spending limit and bonus rewards on creator business expenses, camera equipment, editing software, and studio costs. Whether the model scales over time depends on how stable platform revenue remains as algorithms change. What it represents is a formal recognition that reliable income no longer requires an employer.